cap table, basically like part of the financial DNA of the company. Well, we'll just fix it at the next financing round. And that's dangerous. Having a early co-founder giving too much of a big split in terms of shares and then they leave. And it's a huge red flag for investors.
Hey everyone, it's Daniel from Just Paid. We have Mate, who is a partner of the Just Paid platform. And we wanted to have him on because I think that there's different mechanisms to make a company successful. And a lot of people don't focus on this one mechanism. So of course, like there's the build something people want. That's the core thing, and then make something that everybody wants to buy. But then there's incentives. And that's another piece of what makes, I would say, this Silicon Valley company successful. There's things like RSUs, stock options, stock grants, and just different terminology and different things that'll help motivate a lot of parties to like build a company together. And I wanted to have Mate on. He works with us directly and he works with a lot of different startups in Silicon Valley. And essentially there's this mechanism, the cap table, the capitalization table, where people are given shares or stock options or RSUs in companies. And Mate is, I would say, an expert in managing the cap table for companies. I guess, Mate, why don't you give an intro of who you are?
Sure. Mate zgombic, owner and operator of captablepro.co. We're the human service layer that sits on top, either your carta or pulley account, whichever software platform you're using, to help guide you and also do the administration work that requires on a day-to-day basis, whether you're a one-man band and a founder starting out or, getting ready for IPO. So that's sort of what we do here at captablepro. Started humble beginnings as a corporate paralegal in Silicon Valley, firms like Fenwick and West, who were Proctor, and moved on to a few boutique corporate law firms, helping them build out paralegal practice. And here today, thank you for having me on.
Let's just talk about the cap table for a minute. And this is something, I think it's like a very big motivator for companies because people, they want to work at a cool startup. There's this get rich thing going on. And I would call it like a lot of these companies, and a lot of the incentives are structured around the cap table. Like rolling back in history, the cap table was done on like spreadsheets. Were you around during that time, like the spreadsheet time where people would just like do this in Excel?
Yes, I was. That's where I started. 2007, 2008. We were still managing companies' cap tables on spreadsheets. That you all probably heard of Carta. Carta reached out. They were getting just started. They reached out, and I became a subject matter advisor for them building out their MVP. But then that was natural progression going on to software to do more of the mechanical work and keeping track of shares, options, any securities in the company. It really helped with the mechanics, like automating some of the mechanics, but you still need someone to, on an expert level to do the data input, make sure it's okay, and someone to guide you through the process as well.
Got it. So like back then, Excel, it was rough. I think it was way harder back then to like manage a lot of employees.
Yeah, a lot of time spent on that.
And then I guess you saw the actual like evolution, and a lot of founders today literally are just starting their companies for the first time. They just assume all this software is here, like Pulley and Carta and a few of these other ones that are out there. You saw this evolution. Were you like excited by it? Did you think it was going to like stick? Like when this Excel sheets to like software? Like
I did. I saw the natural progression. It's one of those ideas that were like kind of a no-brainer. After the fact, 2020 hindsight is like, oh yeah, that's that's something that should have been done.
Was that when it started to happen in 2020, or like when would you say it really started to like that you felt that shift from?
When Carta pretty much, I always thought about being in the hanging out with the startups, tech savvy folks. That this could be a lot of this could be automated.
Got it. You saw it happen. I think I started to see it happen in like 2011, like 2012, 13. I felt rumblings of like Carta was there and there were others just starting to like say all this stuff that's in Excel can be like managed through software. I guess a question for you, like why should startups even care about cap tables? Like a lot of them don't even, it's an afterthought. Maybe you could walk us through like why care about the cap table and all of that. Like what's the reason for a startup?
Well, basically it encompasses to capture the mathematical truth of like who owns what, on what terms, how that changes over time. Basically like part of the financial DNA of the company. You really want to make sure that you're tracking it in real time as quickly as possible because any errors can compound over time and cause a headache during the next financing round.
So it sounds like for the financing round, you need a cap table in place. I guess there's different type of entities, right? So there's an LLC, there's an S corp, and then there's a Delaware C corp, and then there's others. Like I think there's a B corp and others like that. But what type of company needs to have this structure in place?
So if you're thinking about raising venture capital money, almost always they want you to be a Delaware C Corp or standard because it supports like preferred stock, clean governance, equity comp, and QSBS eligibility. That's qualified small business stock, tax incentives for investors to invest in the company.
Got it. Like you were a paralegal. Like how did you even get into that? What made you go towards that area?
I don't really know. I kind of just fell into it, I think. Yeah, I was moving from the East Coast to the West Coast. I always had the entrepreneur spirit, and I knew I wanted to be adjacent to that somehow. And I guess help other entrepreneurs some fashion. That just made sense at the time.
Well, got it. So you just found, I guess, a law firm, right?
Yeah,
They started working with you, and then you started to manage cap tables for startups. I guess I'm assuming, like small startups
yeah.
at
So
first.
part of the corporate paralegal gig was to do cap table management or other things like drafting documents, for financing. Everything that your corporate lawyer would do was basically supporting the corporate lawyer and advising the startups. So.
So, Marty, a lot of founders actually listen to our podcast, and I think one question that founders would be having is about dilution. So, I just wanted to know your thoughts on dilution, right? So, if we just get into that topic, so how much equity should a founder typically give away per round, and how does that reflect on your software? Is this all easy to manage on CapTable Pro? How does that work?
Just to be clear, we're not. Capital Pro doesn't offer its own software. We work on top of either Carter or Pulley. But to answer your question more directly, is there are norms like in the startup venture capital space. So like 10 to 20% at seed, usually that's like the range that you give away at that stage, and like 15 to 25% at Series A. It's also really scenario driven. Question isn't really how much should I give, but what does this do to my long term ownership and control of the company? So that's what I would say. That there's norms, but a lot of it's also scenario driven.
So just to follow up on that, just wanted some pointers there. So, do you think a founder sitting at around 10% ownership at a Series B round, is that a good or a bad thing?
10% of Series B is a little bit, well, having, you mean like giving away 10% or like having left with 10%?
Having left with 10%.
10% Series B is a little bit low, but it could be great or terrible depending on how you got there, right? So, like, if the company's scaling, the valuation is strong, and the founder still controls the board, 10% can be incredibly valuable. But if you got there because like messy early rounds or stack safes, that's a problem. That could be a problem, right? So that's how I kind of think about that.
So you guys actually are as a proper dedicated team that comes in place and uses all the tools like Carta and helps the companies, or what are the kind of services that you guys offer, or how do you guys operate if a company wants to reach out to you? So what's your operation basis? Like how do you come in and how do you help out?
Yeah, so we could work earlier the better. Basically, yeah, they have a Carter account or Fully account, whatever software they're using. As early as helping you onboard as part of your incorporation onto a software platform. Answering questions, bespoke questions regarding maybe they're getting ready for a financing. They could say, "I need help with," or I can help them with scenario modeling and certain valuations, how much money you want to raise, how that affects their dilution, what to put in the pitch deck, certain things. So we kind of do like advise. We also do like startup advisory, but also like the heavy lifting for the scenario modeling. And then after the financing round is done, or even during the financing, like getting ready for diligence, and then after financing's done, updating their Carter pulley. And then after you get financing, you get a 49A, you help with that process.
Now, because we're living in the age of AI, there's so many AI models right now. I think Claude also just released their own new AI model, which is Opus 4.7. And I see a lot of companies integrating some form of AI just to look into all their finances, pull all the data from Mercury, from Stripe, and all the integration platforms, right? And then just give some pointers on where their company sits. So, do you guys also use some kind of custom AI models that actually help companies with everything in terms of like fundraising, stock plan, and audits?
Not currently. I am kind of looking at parameters and things and how we can help there, but we're currently not doing that now.
You've used a lot of tools in the past, Like, I just did a quick query of like, what are some of the tools? So there's Carta, there's Pulley, there's Ledgely for European companies, there's Cake Equity for like smaller companies, the ShareWorks, and there's a few others out there. For me, I kind of view, and I live in Silicon Valley, I'm kind of in a bubble. Like, I view Carta as almost the de facto that I've seen most companies go towards. Is that the right thinking, or is it way more heterogeneous, or is it more homogeneous, just with a lot of people using Carta?
Yeah, they're definitely a market leader. They are a little more expensive, but their tooling as you scale becomes very helpful. They have a lot of extra tools that especially later stage companies benefit from. It's important to know that, some founders assume that the platform is doing the math. They forget that it's only as accurate as the data you enter into it. So that's another thing to keep them mindful of.
Again, this is where I think for small startups working with you, it's great because they kind of set that, I'd call it like equity hygiene.
Yeah.
And we work directly with Mate for all of our listeners. So we do like a monthly check-in where we check out and make sure everybody's equity is appropriately set up correctly at our company. I guess equity hygiene, it might be an afterthought for a lot of startups. Do you see a lot
Yeah.
of startups come in with like messy cap tables, things they forgot? I'm
Yeah.
assuming it happens a lot.
Yeah, the one I hear a lot too is, well, we'll just fix it at the next financing round. And that's dangerous because that could stall your financing and also create a lot of extra legal fees. I suggest getting someone, an expert to start early. So you do, like you said, you have the hygiene up in front. Benefit is that someone proactively is watching you on a day-to-day basis and then it's updated constantly.
I mean, I guess what's one example of like an offender? Somewhat, I mean, in my mind, it's like someone doesn't sign something.
Yeah, it doesn't get signed for issuing up shares. That even that like 10-cent check for like 1 million shares is not given. 83Bs is another one too. Like if you don't file an 83B within like a 30-day deadline, it could be tax consequential for the founder.
I don't know if maybe a lot of founders know what that is. What's an 83B election? Like, what is
So
that?
yeah, it's a form you file with the IRS, basically saying you get taxed at the then rate, and the then price per share rather than when it vests. So like if you're on a 4-year vesting schedule and the shares are worth a cent today, you pay a cent times whatever shares you have as your taxable income that day, instead of like let's say 4 years, your next investing, or 2 years, whatever the vesting schedule is, the next, it's at 10 cents. Then you would pay the spread between those two prices. So basically, you're paying the whole price at the time. It gives you the ability to do that now versus, when the company might be valued higher later.
And just to backtrack, for all of our listeners, Mate is talking about American companies specifically. So, like, that's what you only work with, Mate? Only so, say, a European company came to you or a company from India. Do you work
Yeah.
with them or just strictly American?
Yeah. The founders themselves can be based overseas, but U.S. incorporated C corporations, private companies. So not like public companies like Microsoft or any publicly listed traded company.
Do you see a lot of founders living in other countries that incorporate here?
Yep.
You do. Okay, so that happens a lot. Why would they do that? Like, I guess I know reasons, but like, explain like why would a founder do that?
To get financing from the United States investors, VCs tend to invest in US-based corps. It's one reason. Sometimes they plan on coming to the States right after they raise some money.
Okay, so it's more financing than anything. And I'm assuming like the investors have more protections for the incorporated company here.
Yeah.
I know for crypto, a lot of them don't incorporate in the United States. Like, do they have normal entities?
Crypto companies that are customers of mine, they are U.S. incorporated companies that do have like your typical standard equity, U.S. company issuing equity. They'll also like sometimes issue crypto or promises of future crypto tokens.
Okay, so they're incorporating here, I guess, just because they want to feel. For me, it's like a security blanket when a company incorporates in the U.S. because then they're part of the U.S. Regulation and laws here. So I like that.
Yeah, and there's crypto companies that don't even, I guess, incorporate it, right? But it's not something I would take on as a client or
Right.
invest in.
Just wanted to, dive into terms, risk, and red flags a little bit. So, just wanted to know what could be some common red flags in like term sheets. Any point is that?
Yeah, sure. So like the biggest red flag, usually where you want to see this is in your new charter of the company, like participating preferred. It's a term used to like where multiple liquidation preferences. Sometimes that can be red flag depending on if it's participating shares. If there's like a multiple on participation on that, I know there's a lot of word salad there. I can go probably use a whole podcast on that.
So maybe if you want to share some pointers on that too, because so what is a liquidation preference and why does that even matter?
Yeah, so liquidation preference is basically the the order in which certain classes of stock get paid. So typically, go if you hold the company holds like debt would get paid first, then preferred, and then common upon liquidation event. There are like nuances to it, right? There could be basically conversion mechanics where like the preferreds decide to convert to common first before getting paid. It really depends. Scenario driven again, so it really depends. Participation rights piece also to look out for in the term sheet is like upon that liquidation event. Oh, so you liquidate event is that if the preferred has like a 2x participation right, that means they get 2x times the amount of funds before the next preference, which would be a common, get paid. So could have negative outcomes for founders, right?
Just taking a scenario here, let's say a company has just received their safe note, let's say as SF based AI company, and they also got a term sheet from other investors too. And let's say they are kind of, seeing some red flags. So can they reach out to you, Mate, and then get your advice on this? And would you be helping them out in restructuring it, or how would that partnership kind of work?
So just disclaimer, I'm not an attorney. Captable Pro is not an attorney, so we don't give legal advice, but we can certainly, based on experience, let you know how things might play out there with scenario modeling and things like that. But we do have counsel in our network that could help you advise on certain scenarios.
Another question from my end would actually be about a debt. How does taking on debt affect the entire cap table? Maybe if you want to shed some light there too.
So few debt instruments. So in terms of how it affects the cap table, typically standard is convertible promissory notes. So it's an instrument of debt that also could convert into typically preferred shares at like your next financing round. So that's nothing to keep an eye out on when raising or even issuing the convertible notes to see how that may affect dilution of the company in the future.
And regarding this one service that you guys offer is scenario modeling, right? And where you guys actually model financing transactions, option pools, and equity grants, so you understand the dilution and future ownership. How does this entire process work? Like, how do you guys work with companies in this? Do you sit with them on like weekly calls and get all their financing, share some advice there? Just trying to understand the workings of CapTable Pro so that our listeners who are also founders could reach out to you and partner with you as well.
So we work with the founder. We're flexible in terms of cadences, depending on how, like, if you're in the middle of financing or getting ready for financing, the calls might be more frequent, right? But then we have other services where, like, we help with issuing stock options or equity to your team members. So, like, we proactively check to see if you're hiring, and then we proactively basically take the details from the offer letter, put them into the software system, whatever you're using. And so instead of having to go back and forth, we have processes and workflows within our company that makes it more seamless, like traditional ways of doing it.
And one question I do have for both of you, Daniel and Mate, that would be regarding mergers and acquisitions. So let's say the company that you guys are working with is just getting acquired. Is that a service that you guys help out with as well? At the time of the acquisition, how does the equity play out and what the members of the team are going to get and, what the acquiring company. So how would the conversations here look like? What are the internals? If you can share some pointers on this.
I don't think I really have anything on that except for that we help support the legal counsel when it comes to that transaction, diligence and any other stuff that's required. But we're more like on the support side of the general counsel there.
You find a really good counsel that has like an acquisition team. It's people buying a company, right? So you have another company buy your company. So it's two parties coming together, agreeing like together they're going to have a win, hopefully, unless it's like a stressful acquisition where the company is going to go bankrupt or something like that, which does happen quite a bit. There's a lot of startups that struggle. Generally, what happens is like a math equation almost with just who gets what. Mate kind of said it like every debt provider usually gets paid first. They have seniority. So if you owe anybody like money in terms of like venture debt or any other forms of like debt like that, they generally get paid out first. Then the preferred investors get paid, and then the company gets paid. Sometimes it's a win where everybody, like, it's a company that is getting sold for like, I don't know, the price. Generally, it's a win for everybody, and everybody kind of just is super happy with those types of exits. Mate's team would come in and he would just structure, okay, who gets what based off of the math equation. And it's like almost like a pizza pie where like this person gets this percent, this person gets this percent, this person gets this percent. Generally, there's a team, there's a like acquisition team. And I would say Mate would just jump in there and be like, okay, I've been working in Pulley for 10 years for this company, or 5 years or 2 years for this company. I have the pie, the pizza pie, and the equation to distribute. The lawyers would work with Mate's team to really just look at all of that to make sure it's like done appropriately. Legally, everybody gets like what they are owed. I mean, acquisitions that are good are like, you know, you're selling for like a huge amount that people are all happy with. I would call it like a home run. Instagram. Sure, Instagram could have become like a $20 billion company, but at $1 billion, and they had a small team and the investors were involved, like had a big home run. I consider that like a mega exit where everybody was extremely happy, and then the pizza pie was divvied up to everyone that was in this startup. They're out there. There's a lot of them. You could just look them up. But those are the ones where like I think it's a really great exit. And then there's the ones that are disastrous where the pizza pie was this big and then the company is sold for like parts essentially. So you have no pizza left to give out to the investors, to give out to the founders, and then everybody walks away at a loss. That happens a lot too. Startups are a risky game where you make less than what you had. And the investors take that risk. You know, they're betting on a startup. They're making a bet. If you don't have a team like Mate's team, it's hard to have an exit if you're not tracking everything. If you're not like having a team that's looking at this stuff, you have to have that in place or else things get really messy. Like I don't know, it's not having the formula right. It's like not even knowing how to make the pizza right, if that makes sense. I guess, Mate, what's like a red flag? What's a number one reason companies screw up? Like you talk to them and you're like, hey, this needs to get cleaned up immediately. I've seen this before. Is there anything like that? Or is it all different?
Having a early co-founder getting too much of a big split in terms of shares, and then they leave after they've like the vesting schedule wasn't like set up properly. Like you didn't put a vesting schedule in place. Those are like huge red flags because now that this person who left owns a lot of part of the company, and it's a huge red flag for investors because that they don't want to take the risk on that.
So a vesting schedule for everyone, that's just like you don't give the shares immediately, right?
You issue the shares, but they vest over a certain period of time, meaning that if they don't vest, the person leaves and it doesn't work out, the company has the right to buy back a portion that has not vested yet. So they don't have that red flag.
You see that a lot? Is that something you've seen? Like people just say, those are my shares. I want them immediately, no vesting. And then,
No, it's not. It's rare.
okay.
It's typically if you don't have like someone like a lawyer or someone like myself in your corner to tell you that's not how you should do it, right? Like because of these that could cause major red flags and headaches and hard to get financing and that kind of thing.
I was listening to another podcast actually with Tom Bloomfield, who started Monzo, big company in England. And he before that, he was at another startup and they just promised him the equity without ever having signed anything. And he had mentioned it got really messy, I guess, where I guess if you don't sign anything, the equity is really not yours. Right. So it's like, yeah, we promise you the equity, and then you don't sign anything. It's kind of non-existent.
Kind of reminds me of the Facebook debacle with the Winklevosses and somewhat similar. And also, I can't remember the guy's name that financed early on.
Yeah, the Winklevoss twins, and I can't remember his name either. So that was similar. Was that similar in that way?
I think there's some aspects that might have been similar. I mean, you always risk instead of them saying, "Hey, you promised me equity, you never gave it to me." Now this company's worth $100 billion or whatever, and like they come after it. They have this lawsuit that maybe it turns out that technically it shouldn't have been issued, but now you spent all money on legal fees and settlement, and it's not a good use of money.
I think the Winklevoss twins had an email chain. That's the way that they proved that they were involved in some way. So they didn't actually, you're right, they didn't have like a cap table structure with Mark Zuckerberg set up with everything that should be there.
They didn't get issued the shares.
Yeah.
On the cap table.
So that was messy.
Yeah, I think my question was about the Facebook thing itself. I think there was a scene in this social network. I don't know how true that was, where they were just signing out of the equity, and then he just had no lawyers, and then he just signs it off and then he lost his company, right? One played by Andrew Garfield. So I don't know if you watched that scene, Mate, but do you think if Cap Table Pro was there in that scenario, it would have helped them out a lot?
Man, I wouldn't advise anyone to do that. But yeah, I mean, we're like again, we're not legal, we're not attorneys, so we don't advise on that. But also we're founder first, so founder friendly. We're thinking about that in that respect, making sure all the I's are dotted and T's are crossed. But yeah, that's I remember that scene. I think that's the guy I was referencing earlier. I can't remember his name.
Eduardo. Now I remember.
Yeah,
Eduardo.
yeah, that's it. Yeah.
That was a good movie. It actually shows you a lot about equity, but I guess always have mate in your corner and a good lawyer. And then those sorts of things don't happen where you don't know what you're signing. I guess to switch gears a little bit, like AI, because Carta is there and all of these other tools are there, do you think AI is going to play a part in tools in the future? Or do you think it's not reliable enough? Or do you think it is there today? Like, what are your thoughts on all this?
Yeah, I think it will play a part in the future. I don't think it's reliable now. I mean, even I get to refresh my memory on certain things. Type in, refresh my memory on this happened a minute ago on QSBS, right? Because the QSBS got updated in the One Beautiful bill recently, and it gave me the olive.
Wow.
Yeah, so I was like, I don't think that's right because I remember.
Okay.
So yeah, I think got a long way to go in terms of like research, helping with research and stuff. But I think it will play a part in the future.
For the founders out there, don't fully trust it. Don't just throw it into Claude and think it's all going to work itself out correctly, which people are doing. They're doing that today. So it's like, it sounds like they're not relying on lawyers or your team, which is scary. So you saw errors already in it.
Yeah.
Even at how good it's getting, it's not there yet. So it sounds like you don't work with it when you're dealing with cap tables. You're always human looking at it, making sure it's exactly the way it should be.
Yes. Yeah. 100%. Yeah.
A lot of founders love AI. It's just it's the quick, easy thing. Let me do this instead of a lawyer. Let me do that instead of the cap table. I'll just have the AI figure it out. So it could go haywire like what it did to you. So a thing for founders out there, like when do you think it'll get there? 5 years, 10 years? Like what are your thoughts on AI? And what is it going to do? Like, what is it even going to do in cap tables?
It's going to move fast. I think one of the things that I'm thinking about is like agents, how agents can help my day to day with managing. Yeah, I think we're really close. Maybe 5 years, maybe even less. Because it's moving so fast. It's hard to say.
Yeah, agents are powerful.
So I think it would be about agents too. Like future forward, Mate, do you think you guys would maybe deploy an agent which would actually be like a virtual employee within your Slack, which could then go ahead and talk to the customers, ask them for like weekly updates. The agent just goes ahead and takes all the weekly updates and intimates you, and then you take your decisions and then update that with the founder. I'm just trying to, throw an idea out on a workflow. So is
Yeah.
that something that you guys would use down the line, an agent like an AI employee inside your company?
I don't think I would use it for customer facing, but I am thinking about maybe some of the back within my company doing some of the things that agents can do in terms of like data extraction inputs, but I always think that we need as of now. I don't know how far this is true, but you always need that human layer expert as the top level check. So that's where I'm thinking about it right now.
But it's actually very true because a lot of, like I think Daniel also mentioned, a lot of founders would just rely on, sitting down and prompting Claude. But that's definitely not the right way to proceed as well because you need experience, you need real humans, like human in the loop, right? You need humans like what you guys actually are offering. You as a team would come in and properly sit down with the company, right? That's super important. But yes, that mixed up with agents, would be cool to see.
It's definitely a strange world. Like even this week, I was like with Claude, I asked it to create one document and it decided to create like 20. Just little things like that. If you do that with equity, it's very dangerous where it could like make mistakes and a founder wouldn't even know what's happening before their eyes. Mate would probably catch it in a second and be like, that's incorrect. I asked it to do this, it's doing this. Because you've seen so many companies, Mate, so others may not catch the nuances that AI could like misconstrue something.
Yeah, especially if you're a first time founder or even someone who always relied on somebody else, even if you're 3, 4, 5 time founder, there are a lot of nuances. So yeah, I totally agree there.
I feel like this is one where founders don't realize what they need. So like if you're a founder, definitely reach out to Mate. He's willing to do a quick review with you and look at your company and see where he can help. I think every founder should have someone in their corner like that because if you're building a company that you want to be huge and successful, like a Delaware C Corp, having a team like Mate is important. So your website, Mate, and where can they reach you?
Our website is captablepro.co.
So if anybody has questions, go there. Mate is happy to just meet with you and just have a sit down with you and kind of review everything to get you started and get you set up for success. Well, thank you, Mate. This was a great episode. I appreciate you being on. And
Thanks, guys. Appreciate you guys having me on.